Well, interest rates are sitting at near 6-week highs. You've got to go back to December 12th of last year to see rates as high as they are today. So what's moving the markets? We are going to talk about it in this video. So let's get right into the numbers. Mortgage News Daily has the daily tracking poll for a 30-year fixed rate conforming loan. Again, this is a composite of national rates. This is not our local rates. We're usually significantly lower than this. So if you do have a client that is shopping a mortgage, the rates I'm providing here are, again, our national averages as tracked by Mortgage News Daily. They are not our actual rates. So folks need to call me if they want to get specific to their scenario, and they will likely see something that's cheaper than this in all likelihood. So today, Mortgage News Daily, 6.89 for a 30-year fixed rate mortgage. Last week we were at 6.72, so we were up over 1/8 of a point in rate in the last week. If you go back 30 days, we were at 6.64, so we're up about 1/3 of a point in the last 30 days. And we see a number of things that are contributing to this, y'all, and I'll just go through what's given us this latest bump upward, the weakness in the bond market that we are seeing. On Tuesday, we had the Fed's Waller give a speech in which he indicated that the pace and timing of cuts may be quite a bit slower than what the market is anticipating. He indicated that the Fed's deliberations are to be very careful, slow, and methodical about these cuts. He went on to emphasize that if they were to cut and then have higher inflationary news come out, that undoing those cuts would be very, very damaging to the market. He's probably not wrong about that. It would be viewed as indecisiveness on the part of the Fed, and that could add to some market instability, which would not necessarily be good. So the Fed is indicating that they are likely to be measured in this approach. At least that's Waller's opinion. Bond market sold off sharply on that. That was the move this week that gave us the biggest bump in rates, the biggest sell-off in the bond market was those comments. Wednesday, we got retail sales. They came in quite a bit stronger than expected. They came in up 0.6%. The market was anticipating them being up 0.4%. So that stronger read suggests more strength in consumer spending that is at its core inflationary, especially to the extent that it floods the market with additional dollars. When you got that much purchasing power, you've got the ability to raise prices into that demand, and that's inflationary on its face. So that definitely didn't help us with regard to bonds this week. And then today we had jobless claims, which came in lower than expected. 187,000 new jobless claims versus 208,000 projected. Now, while those are not wildly apart, 16,000 jobs is not a huge miss on that report to the upside. That report is being discounted quite a bit because it's not uncommon to see jobless claims drop with data including the holidays at the end of the year. So may see revisions to that down the road. The market was not as concerned about that. We didn't see much change today over yesterday. We were at 6.88 nationally yesterday. So 1/100 of a point is all we've moved in the overnight based on that jobless claims number. So in any event, what we don't have is good news for interest rates. We see these reports that are weighing heavily on where we are. All eyes are on the Fed. The market has priced in a number of cuts for 2024. Any news that comes in that could derail that projection is going to be immediately reflected in bond prices, and that's what we're seeing. So in any event, y'all call me for details of any scenario that you have. We are seeing a dramatic uptick in activity, which is very encouraging for this year. We're still seeing rates, about 1.4 points lower than they were at the high of October of last year. So folks are starting to get the message that at least locally, we're seeing some tax benefits as well in Texas due to some legislation that was very favorable for folks that own a primary residence in Texas with regard to their homestead exemption. When you factor in the tax savings, the fact that rates are nearly 1.5 points lower than from their highs of this last year, houses are way more affordable now than they were 4 months ago. So something to ponder as we go into this year, starting to see activity reflect that reality, and always looking for more opportunity to help you and your clients. So we're blessed to have your referrals. We do mortgages for a living here. We look forward to hearing from you soon to discuss a specific scenario on behalf of your clients. So stay blessed, stay safe. We will talk to you next week.